You've learned to read the market's mind, and you've mastered the discipline of waiting. But none of that matters if you don't have a rigid structure in place. Because the moment you take a big loss, your discipline vanishes, and your inner gambling addict takes over. The truth is, trading without rules is trading without memory. You are guaranteed to repeat the same mistakes over and over because you have no objective boundary to stop you. Your emotional mind will always tell you, just one more trade, you can get it back. This video is not about giving you a checklist of generic advice. This is about building a psychological fortress against your own self-sabotage. We are going to install 3 non-negotiable sets of rules: risk rules, execution rules, and stop rules that will replace your emotions with logic. Mastering these rules is the difference between a successful business and a hobby that bleeds cash. The first set of rules protects your capital, and more importantly, protects your psychology from the urge to take revenge. The lie is, the market owes you the money you just lost. The psychological truth is, the market doesn't care about your loss. Your anger is a psychological trigger designed to make you double down and lose even more. The most critical rule here is the daily loss limit. You must set a non-negotiable maximum loss you can take in a single day, expressed as a percentage of your total account. We recommend 2%. Once you hit that 2% loss, your trading day is over, period. No exceptions. This rule shifts your focus from recovering a loss to preserving your mental state. If you know you only lose 2%, you can walk away and say, that was the cost of doing business today. When you don't have that limit, your loss can spiral to 10%, 20% or more, leading to a psychological burnout that takes weeks to recover from. Next, the maximum risk per trade. Never risk more than 0.5 to 1% of your total account on any single trade. If your account is $10,000, you are risking a maximum of $100. This is the ultimate tool to neutralize oversizing. When you risk too much, the psychological pressure of seeing a large floating loss makes you panic exit prematurely or move your stop. By keeping the risk small, the financial fluctuations feel negligible, allowing you to let your trade setup play out logically. These 2 rules create a buffer for your mind. They force your loss to be small and finite, preventing your primal urge for revenge from ever taking over. The second set of rules dictates exactly when and how you enter and manage a trade. These rules are designed to stop you from tinkering with a trade once it's live. The lie is, I can just adjust my stop loss a little bit and price will reverse. The psychological truth is, once you enter a trade, you are subject to confirmation bias and anchoring. You are anchored to the belief that you are right, and you look for any reason to keep the trade alive, even if the market clearly invalidates it. The most important execution rule is the set it and forget it rule. Once you enter a trade, and your stop loss and take profit levels are set according to your strategy, you must not touch them. The only exception is moving the stop to break even once your target is confirmed by your analysis. The minute you move your stop further away, you have abandoned your plan and started hoping. Hope is not a strategy. It is a way to drain your account. Next, the entry confirmation rule. Never trade solely on a visual pattern. Your entry must be confirmed by at least 2 separate, objective indicators or criteria that align with your strategy. This forces you to be disciplined and wait. For example, I only enter a long trade when price is above the 200 period moving average and the RSI is exiting an oversold reading. This rule prevents impulse entries and ensures you are trading probability, not excitement. Finally, the trade exit rule. Define your exit criteria before you enter. This is often the most neglected rule. Will you scale out at 1-to-1 risk-reward? Will you hold until the trend line breaks? When price is moving against you, your fear screams, "Get out now." Your exit rule is the only thing that allows you to trust your plan and avoid cutting a potentially profitable trade short. Trading is a battle between your plan and your emotions. Your execution rules ensure the plan wins.
The third set of rules dictates the timing and volume of your trading activity. These rules counter the dopamine addiction that causes overtrading and burnout. The lie is, I need to be in the market all the time to make money. The psychological truth is, the market only trends strongly 20% of the time. The other 80% is choppy noise designed to steal your capital. The most effective rule here is the 3 strikes and you're out rule. If you take 3 consecutive losses, even small ones, you must immediately step away from the charts for the rest of the day. A string of 3 losses signals 2 things. First, your strategy is temporarily out of sync with current market conditions. Second, and more importantly, your emotional state is now compromised and your discipline is degrading. This rule forces a psychological reset before the losses become catastrophic. Next, the no trade time rule. Define specific high-risk times when you will not trade. This could be 30 minutes before a major news event or during the low-volume chop in the middle of the day. This rule eliminates trading during periods of high randomness, where the noise is louder than the signal. Trading less is not a limit, it's an optimization. Finally, the end-of-week review rule. This is the meta rule that keeps your whole system functioning. Every Friday, spend 30 minutes reviewing your journal. Did you follow your rules? Yes or no? If you broke a rule, write down why and what emotion drove that decision. If you have 4 or more rule breaches in a week, you must take the following week off to reset your mindset. This accountability rule ensures you never drift from your plan and makes rule following a habit. You now have the framework to build your psychological fortress. You have the capital protection rules to stop revenge trading. You have the execution rules to eliminate hope and tinkering. And you have the daily and weekly rules to counter your addiction to action. Here's a key takeaway. Your trading rules are not designed to limit your profit. They are designed to limit your humanity. They are your emotional shield. The master trader doesn't win by being a genius. They win by having the discipline to follow a simple, quantified plan when everyone else is guided by fear and greed. If you are ready to stop trading your emotions and start trading your rules, hit the like button and subscribe. I'll see you in the next video.